The bank charter now represents what it always has represented, which is the keys to the financial kingdom.
Getting the charter and getting all the approvals and opening your door is really the day one. Real challenge starts after
the forward-leaning quality of the current administration has not been matched by other administrations. The potential that a new Democratic administration may return to that previous status quo.
These banks are like the dogs who caught the car. Okay, do we know how to drive it? We're dogs.
This is Inside the Vault. I'm Ted Huff, here with Steve Bishop. Let's talk about what bank charter actually means and what it doesn't. Welcome to Fintech Confidential, bringing you the people, tech, and companies that change how you pay and get paid. Welcome to Inside the Vault. I'm Ted Huff, the CEO of fintech advisory firm Bollier. Today, I'm joined by Fintech Confidential informant Steve Bishop, and we're talking about bank charters today, specifically why so many people are confused about them right now, and why that confusion is starting to cost real money.
And Ted, you've been watching this play out for a while now at Bollier. What made you want to do a full episode on it?
Well, honestly, it's the phone calls. Founders who just announced a charter application, bank executives trying to figure out what a competitor's trust charter actually means for them, board members who got a briefing and still couldn't explain what their company had actually done. And honestly, the word charter is doing a lot of heavy lifting right now, and it's not always earning all of it.
And we brought some serious people to help unpack it. We have Syed Raza, who is a chief innovation officer at the OCC before joining FTI Consulting. He's seen how these decisions look from the inside the regulator's office.
We did. We also talked to Michele Alt at the Claros Group, former OCC, who now advises management teams on exactly these structural choices.
And Ian Moloney at the American Fintech Council, who works with fintech companies and their bank partners on the Hill, translating what these regulatory shifts mean for how the programs actually operate. 3 different vantage points on the same set of questions. And I will say a lot of what we're going to cover today is stuff I've been hearing in conversations that don't actually make it to a public panel. That's kind of the whole point of what I do. These are questions boards and examiners are asking when the cameras are off. And a lot of the time, the answers are not as clean as a press release make them sound. Let's be honest, that gap is costing some teams real money right now.
Right. And what's really interesting is where our featured guest agreed and where they didn't. We're going to work through all of this, what a bank charter actually is, why trust charters are everywhere right now, the Fed master account gap, which is the place most people are really not talking about. And not only that, but what all of this means for sponsor banking. And last but not least, what to watch over the next 6 to 12 months. So let's get started with something that, well, sounds pretty basic, but turns out not to be. Support provided by Skyflow. What if you could build fast but not break privacy? What if you could ensure data privacy, governance, and compliance with just a few API calls? What if you could worry less about PCI requirements while actually improving privacy and security? How much more time would your team have to truly innovate? How much faster could you build and ship new features? How much more powerful could your app be? Skyflow is a zero-trust data privacy vault delivered as an API. Skyflow's radically simple design lets you collect, secure, and tokenize personal information like card data and payment details. And with built-in features like encrypted data analysis and sharing, anonymization, and advanced governance, your days of choosing between data security and data usability are over. Whether you're just concerned with PCI compliance or need to go further to include CCPA, GDPR, SOC 2, and beyond, Skyflow has you covered. What if you could build fast but not break privacy? With Skyflow, you can. Visit skyflowsecure.com today to learn how.
Ted, when someone says their company is getting a bank charter, what are they actually saying?
Well, they may be saying about 7 different things all at the same time. And well, that's the problem. A bank charter is the legal authorization to operate as a financial institution under specific regulatory authority. It really just defines who approved you, what you can do, and who gets to examine you. And the last part, that's one that matters most and generally gets the least amount of attention. The OCC charters national banks and federal savings associations, state banking regulators, charter state banks, and whether the Federal Reserve or the FDIC layers on top of that really depends on status and where the institution carries deposit insurance. You can end up chartered in one place and examined by 3 different agencies.
So when a fintech announces a charter, that announcement tells you almost nothing on its own.
Well, that's right, Steve. You could be a national bank, a state bank, a federal savings association, industrial loan company, a trust bank, a national trust bank. None of these things are the same. And saying we got a charter without naming the type leaves out the part that really matters.
The thing that stands out to me from conversations I've been having is founders are treating the charter announcement as a finish line. I've had a founder tell me that a board celebrated when they had the announcement. If that examiner is going to ask about BSA staffing day one, what do you think a bank charter actually represents, especially right now, and how has that changed?
There are 2 schools of thought in chartering process. There's old school who saw the chartering window close for many, many years. They think it's going to be extremely difficult to go through the national charter process. The other school of thought is mostly new organization, technology, fintech, digital assets. They actually think it's very easy to get a national charter, but they think it's much easier than it actually is. Getting the charter and getting all the approvals and opening your door per se, the day one for the bank is really the day one. Real challenge starts after that.
Yeah, that's a useful reminder that this is not just a label. The real operating consequences depend on which box you're operating in.
And people are not always reading the fine print on which box they're applying for. And that's where the OCC's recent activity really gets interesting, because the OCC just issued a 376-page proposed rule to implement the Genius Act. What it does is create formal issuer categories. Once those categories exist, firms start positioning for the one they think serves them best. The headline is a proposed rule. The practical implication is that stablecoin policy is starting to become operating requirements. And who is the issuer? Who supervises it? What backs it? How does redemption work? And who can prove the controls? These really aren't even product questions anymore. They're compliance questions.
So what should an operator actually take away from that?
Well, I mean, really, there are 4 questions, right? So who grants the charter? What powers come with it? What activities are limited? Who examines the institution? And if a management team can't answer all 4 of those, they're not really done thinking about their charter strategy yet. So where do you think the biggest gaps are between what people believe about the chartering process and what it actually involves?
Think of applying for a bank charter as about as much fun as a financial and emotional colonoscopy. If you're thinking that they can do it quickly and painlessly and have an easy ride, you got another thing coming. Still a big lift.
So what does the current regulatory activity tell you about where oversight is headed?
The current regulatory activity shows that there's an opportunity to allow bank managers to manage and to engage in their activities, whether it be fintech companies or stablecoin providers. There's a real opportunity within that chartering conversation, whether it be limited purpose or, more broadly for a national bank charter.
So the OCC has drawn some lines. What we're seeing is firms racing to get on the right side of those lines before the final rule makes the entry cost higher. Translation, if you can't answer those 4 questions about your own program right now, you're not ready for the conversation your bank partner or your examiner is going to have with you. And most visible move right now is trust charters.
Yeah.
Paxos, BitGo, Ripple, all OCC trust charter approvals in a pretty short window. What's actually going on there?
Steve, it's positioning. Firms are trying to get into federal supervisory structure before the markets get more defined, before the final rules make the entry cost even higher. That is strategic logic. The timing is definitely not accidental. And what's most important to understand is that a national trust bank charter is not a full charter. It can put a company inside of the federal supervisory framework. It can support custody activities, certain payment functions, and even stablecoin positioning for them. It doesn't make them a community bank, no insured deposits, no lending authority, and it still brings real examination expectations, governance requirements, capital considerations, and compliance obligations.
So if I'm a fintech founder reading one of those headlines and thinking we should do that next, what's the one thing you want them to slow down on before the application goes in?
What is your read on why trust charters have gotten so much attention lately?
Because it serves a very specific purpose for organizations who are only interested in custody services, crypto wallet, crypto exchanges, and the capital requirements for trust banks are a little bit lower than a full bank. For them, it gives them the regulatory fiduciary authority to get involved in that business, but they are not interested in maintaining deposit accounts or loans. They are not interested in offering traditional deposit accounts or loans.
What are firms actually missing when they go through this process?
Well, getting a trust charter is just the start of the work, not the finish. The regulators' expectations don't wait for the press release to clear.
I want to push on you slightly there. There's a counter argument that I keep hearing. A trust charter creates real credibility with bank partners and institutional investors even before the exam gets serious. Is that wrong or just incomplete?
A trust company, although it is a bank for purposes of state and federal law, and therefore is not subject to all sorts of individual state and local licensing requirements, it is not considered a bank for purposes of the Bank Holding Company Act. So that means you get the benefit to be a bank and conduct your activities nationwide, but you're not subjecting your parent to Bank Holding Company Act supervision. It's huge. But here's the trade-off. Conditional approval for some applicants is it makes it a lot easier for them to raise money. But not everybody's Coinbase.
What tends to get overlooked is the need for good timing on the charter application to make sure that you get in within this administration as opposed to a potential next administration, which may be less favorable in the chartering space.
That Bank Holding Company Act piece is the one I not fully appreciated until I started having these conversations. A trust charter gives you the bank benefits without pulling your entire parent company into Fed supervision. And most of the founders I talk to have no idea that trade-off even exists. And the part that does not make the press release is the one that may matter most operationally.
Right. And the one that matters a lot, more than people seem to realize, is the headline says approved. The operating reality says you may still need some infrastructure you needed before the announcement even happened. So getting a trust charter and getting direct access to Federal Reserve payment rails are two completely different things. Hey, Ted Huff here. Ever thought about how you could streamline your application and underwriting process? Well, let me introduce you to Under. Why keep using the outdated methods of PDFs when you can digitize them effortlessly? All you gotta do is upload the PDF, send it out for digital signature, and voila, you're set for the digital age. Are you curious on how to make that happen? Head over to under.io/FTC and get started for free. It's really that simple.
Ted, walk us through what a Fed Master account actually is and why it matters here.
A Fed Master account is a direct account at the Federal Reserve. It gives an institution access to FedWire, FedNow, and the core payment infrastructure of the United States financial system. If you have one, you can move money directly across those rails. And if you don't have one, you need an intermediary bank or a sponsor bank to do that for you.
So, and a trust charter doesn't automatically come with one?
It doesn't. A trust charter may make a firm eligible to apply for a master account. Then the Fed decides whether to approve it or not. The 10th Circuit confirmed late in 2025 that the Fed has full discretion here. And even when an applicant is legally eligible, the first limited purpose payment account of that kind was approved in March of 2026. And before that, the firms holding trust charters, but without master account, were still routing through partner banks to reach the Fed payment rails.
Okay, so the charter changed the supervisor relationship, but the operating dependency on a partner bank may still be exactly what it was before the charter.
Yeah, and that's the gap. It appears to be the same thing most management teams have not fully priced in when they treat a charter approval as the finish line.
So a trust charter gives the firm eligibility to apply for a Fed master account. Doesn't guarantee one though. How significant is that gap, and what does it mean for those counting on Fed payments as part of their payment strategy?
Don't go with a limited purpose charter if it's an absolute must to have a master account. That's too big a risk because there are no guarantees. I would say they have a choice. Either proceed now with a full service bank application, or they could wait a little bit. We need to wait and see how it shakes out.
The shorter version, institutions without deposit insurance sit in a higher scrutiny tier, which means longer timelines and no guarantee at the end.
You know, what I keep hearing from operators that have gone through this process is timeline assumptions going in were way off, and not just by a week or two. One operator I talked to had an 18-month product roadmap built that required FedRel access. They're now well into that window, but the roadmap hasn't moved.
A trust charter makes a firm eligible for a Fed master account, but it doesn't guarantee one. How significant do you feel the gap is, and what it means for firms counting on Fed payment access as part of their primary strategy?
So I think because of all the developments recently with implementation of Genius Act, there's a very good chance that they will have that access. I have not heard anything otherwise. I think it's a very high probability of and likelihood of people having access to Fed master account if they have a federally chartered banking organization.
So the current gap between getting a charter and getting a Fed master account is a fair size under the current regime. However, it has every sign of shrinking. Directional cues of Governor Waller, as well as the administration, to a broader range of entities.
So which means everything we're about to talk about still applies.
Steve, that is exactly right. The charter changes the supervision picture. It doesn't necessarily change the operating picture. And the sponsor bank conversation is where this gets very real for a lot of people in this audience. So why don't we go ahead and go there?
Let's say you're a community bank or a fintech running a sponsor bank program, no trust charter, no OCC application in the works. Why does any of this matter to you right now?
Steve, because the charter conversation and the stablecoin yield conversation are heading toward the programs, whether they're positioned for it or not. And if a fintech partner gets a charter or starts competing with financial institutions with yield, the structure of the existing programs at the sponsor banks really get tested.
Sponsor banking works on a clear division of roles. The bank holds the regulatory accountability, and the fintech holds the customer relationship.
Well, and what's changing is that some of the fintechs are now pursuing the charters specifically to remove that bank from the equation. And in the meantime, stablecoin yield is starting to compete directly with deposit-funded products at the same community banks running those exact same programs.
The Claribus data suggests deposit movement from stablecoin adjacent products is already underway at community banks. That is not a future risk, it's a current.
How do you think the sponsor bank model is holding up under current pressure? And where do you see it straining?
I think generally the sponsor bank model is holding up quite well. Bank fintech partnerships rely upon ability for banks and fintech companies to leverage their core competencies. And so many fintechs will continue to do that and that will never lead to a charter conversation.
The yield question is where charter strategy and deposit competition converge in the most uncomfortable way.
A firm with a trust charter and a stablecoin product can offer something that looks like yield without carrying deposit insurance, CRA obligations, or the capital requirements a bank carries. Ted, how should a community bank think about that?
Well, the honest answer is that a product paying something that looks like interest on customer balances, well, Steve, it's going to draw scrutiny regardless of what it's called. And banks will flag this competitive gap. Regulators will ask who's accountable when something goes wrong. And the charter type depends on the answer to that question, which is exactly why it matters. What are the banks and fintechs getting wrong about their shared responsibilities in these programs?
Both the sponsored banks and the fintechs are misaligned when it comes to cost sharing, control ownership, and data ownership.
How do you think the sponsor banking model we know today is holding up under the current pressures? And where do you see it straining the most?
I was talking with one of my partners, Seth Ross, about this just this morning, and he had a good line. He said, it's not dead. Sloppy Baz is dead, Seth. So shout out to Seth. Accountability and accurate reconciliation are absolute musts.
So for the sponsor bank that's still in the model, not chasing a charter, not competing on yield yet, what is the one test that tells you whether your program is actually well ran?
Steve, one question. If an examiner walked in today and asked you to walk through the program from customer onboarding to funds movement to exceptions to shutdown, could you do it without calling 3 vendors first? If the answer is no, that is the work that needs to happen. The program documentation, the controls, the oversight structure, that is what gets examined, not the term sheet.
The programs that are going to hold up are the ones where both parties can answer the examiner's questions without calling 3 vendors first. If you can't do that today, then that is the work. We've covered what a charter is and why trust charters are attracting so much attention. Let's talk about what to actually watch.
The thing I'm watching most closely is not the approvals. It's the conditions attached to them, because a conditional charter approval tells you what the regulator saw in the applications. The conditions tell you what they did not trust yet. The firms that close that gap really quickly will be in a completely different position than the ones that are still working on it when the pre-opening exam lands. What are the 1 or 2 things that you are watching most closely right now?
I am really closely watching the organizations they were given conditional approval to see how they will fare with pre-opening exam and the opening process. Secondly, community banks, profit margin model, because as fintechs are coming into very low on overhead, very high on efficiency, so their profit margins are going to be much higher in the banking service as compared to traditional banks. That will add a lot of pressure to traditional banks.
The thing that I keep watching is the enforcement gap on the compliance side, specifically operators who built programs assuming someone downstream handled the AML and the sanctions picture.
The piece I think that is underpriced is the conversation at the state level and that activity. Federal charters and federal preemption gets most of the attention, though, but consumer protection laws sit heavily at the state level and are not preempted by the federal law.
A fintech operating under a sponsoring model is still reachable by states that can't regulate that bank directly. That's where the next wave of enforcement pressure is likely to come from.
A bunch of conversations that we've been having are, don't do de novo if you really need a Fed account. Go find a financial institution you can acquire that already has a master account and acquire them. Or, and you kind of hit on it, is is wait to see what happens, especially after Kraken getting their Fed master account through their Wyoming LLC. What are your thoughts on those options that I've been hearing?
Preparing a decent application takes about 4 months, at least 4 months for the regulators to approve it. And then you've 18 months to build it and get final approval. If you add up that math, you're getting right up and against the next presidential administration. Given the timeline, where you are in your thinking, you might want to be thinking about M&A.
So the through line is that the gap between announcement and operating reality is where the real risk actually lives. And now most firms are closer to the announcement than they are to the reality.
So what I'm personally watching most closely right now is the chartering conversation, the conversation around true lender, and then also no conversation would be complete without discussion of AI.
All right, last question. What do you actually do before the final rules land?
There are 3 things that need to happen. One is watch the final OCC rule for how stablecoin issuer categories get conditioned. The conditions matter way more than the approval. And watch whether trust charter firms can convert this conditional approval into a full charter before this really narrow political window closes. Also, watch deposit movement at community banks and segments already using wallets or yield products, because that pressure is already showing itself present in the data. For operators, don't wait to start your documentation work now. Customer funds flow, legal authority, partner roles, controls, disclosures, exception handling, have it all ready before the examiner asks. If someone were to come to you today and ask you what they should actually do, not just what to watch, and what would you tell them to do?
If you're thinking about doing it, you better get cracking because the clock is ticking.
That is a bank charter confusion episode.
A charter is a supervisory relationship.
A trust charter, it's not a full bank charter.
Getting one doesn't mean Fed payment rail access, and sponsor banks still need to understand what they are actually supporting.
Special thanks to Syed, Michele, and Ian, 3 people with genuinely different views who are direct about all of it. The thing that stayed with me is that the regulatory structure is often moving faster than the operating structure. The announcement is real. The readiness is still catching up.
So if you're building, sponsoring, or supervising one of these programs, we're here to help. And thanks for listening to Inside the Vault. If this discussion got your attention today, there's much more where that came from. Head over to YouTube, Spotify, Apple Podcasts, or wherever you listen and hit follow. And if you want to stay plugged in to everything we're tracking over here, go to fintechconfidential.com and sign up. Be sure to share this with someone who is serious about where fintech is going. And as always, keep moving forward. As we wrap up today's episode, I've got one last thing for you. If you're in the trenches fighting fraud and financial crime, you know it's a complex battlefield. That's where Hawk.ai tools for real-time payment screening, AML, transaction monitoring, and dynamic customer risk rating come into play. These aren't just buzzwords. They're game changers designed to make your compliance more effective and less of a headache. Imagine slashing through false positives with precision and giving your compliance strategy the edge it needs. Head on over to gethawkai.com to sign up for a demo and discover how their platform can revolutionize how you fight fraud and financial crime.
This has been a production of DD3 Media with all rights reserved. This is provided for informational purposes only. It is not offered or intended to be used as legal, tax, investment, financial, or other advice. We strive to provide accurate and up-to-date information, but will not be responsible for any missing facts or inaccurate information. You comply and understand that you should use any of this information at your own risk. Cryptocurrencies are highly volatile financial assets, so research and make your own financial decisions.